Have you ever wondered what kind of money will actually make you richer in the next decade? Imagine waking up in 2035 and realizing that the choice you made today, whether to hold on to physical assets like cash and gold, or to embrace the rising world of digital money, decided the entire future of your financial life. Some people will look back and feel proud, while others will regret ignoring the biggest shift in wealth creation of the century. The battle between physical money and digital money is not just about currency. It's about power, opportunity, and survival in a world that is changing faster than ever before. Right now, billions of people still trust physical money. Cash in wallets, gold stored in vaults, or even property deeds locked in drawers. It feels safe because it's tangible. You can touch it, you can see it, and you can hand it to someone else. For thousands of years, physical money has been the backbone of wealth. Empires were built on gold, kingdoms collapsed when their coins lost value, and wars were fought for physical treasures. On the other hand, digital money has exploded in the last decade. Cryptocurrencies like Bitcoin and Ethereum, stablecoins tied to the dollar, central bank digital currencies being developed across the world, and fintech apps like PayPal or Revolut have completely transformed the way money moves. Digital money is fast, borderless, and growing at a pace we've never seen before. The conflict is clear: physical versus digital. But which will actually make you richer over the next 10 years? To answer that, we need to step back in time. Money itself has always been a story of evolution. Thousands of years ago, people traded seashells, stones, and beads. Eventually, gold and silver became the foundation of wealth, leading to coins and eventually paper currency. For centuries, physical money ruled everything. The Roman Empire thrived on gold coins. European kingdoms rose to power through silver and trade routes. Even in modern times, the US dollar became the world's reserve currency in its physical form. If you held dollars, you held power. But history shows us that money never stays the same forever. In 1971, President Richard Nixon removed the US dollar from the gold standard, making the dollar a fiat currency backed only by government trust. This was a turning point. Money became less about what you could hold in your hand and more about what the system said it was worth. Fast forward to the 21st century, and digital money is emerging as the next great transformation. Why is this important? Because every major shift in money has created winners and losers. Those who adapted early became wealthy. Those who resisted were left behind. When people clung to gold while the world shifted to paper, they missed opportunities. When people ignored the rise of credit cards and digital banking, they limited their financial growth. Today, the same choice stands before us: physical or digital. If you choose wrong, you could be stuck in the past while others build exponential wealth. But before we dive into the future, let's take a closer look at physical money. What makes it strong? What makes it weak? And why do some of the richest people in the world still cling to physical assets as the ultimate form of security? Physical money has been with us for millennia, and for good reason. Its first advantage is tangibility. You can hold gold in your hands, you can store cash in a safe, you can own a physical property deed. That tangible connection gives people psychological security. When banks collapse, when digital systems fail, or when governments impose restrictions, physical assets remain in your possession. For example, during the financial crisis of 2008, countless people lost trust in banks and turned back to gold. Gold prices skyrocketed because investors wanted something they could trust. Physical assets don't depend on servers, apps, or internet connections. If you have them, you own them. Another advantage of physical money is historical resilience. Gold, silver, land, and even cash have survived wars, depressions, and political revolutions. When governments fall, their digital systems vanish, but gold bars and farmland remain. A farmer in the 1800s could leave land to his children, and those descendants could still profit from it today. Generational wealth has always been tied to physical assets. Families like the Rockefellers, the Rothschilds, and many royal dynasties built their empires on tangible wealth. Even in today's high-tech world, billionaires hedge their digital investments with physical property, land, and precious metals. Physical money also offers stability in the face of volatility. Digital markets swing dramatically. Bitcoin can rise or fall 20% in a week, but gold moves slowly. It may rise and fall, but it does so over years, not hours. That slow pace makes physical assets safer in the eyes of conservative investors. Real estate, too, provides both utility and security. People will always need places to live, so physical property has an inherent demand that cannot vanish overnight. However, physical money has its downsides. The first weakness is mobility. Carrying large sums of cash is risky. Transporting gold across borders is complicated and often illegal without government permission. Real estate cannot be moved at all. In a globalized digital world, physical assets can feel heavy, slow, and outdated. They tie you down instead of freeing you. Another disadvantage is inflation. Physical cash loses value as governments print more money. Over the last 50 years, the US dollar has lost over 85% of its purchasing power due to inflation. What cost $1 in 1970 now costs more than $7. If you kept your wealth in physical cash, you got poorer, not richer. Gold does protect against inflation, but even gold can stagnate for decades. Between 1980 and 2000, gold lost nearly 70% of its value when adjusted for inflation. People who held only gold during that time saw their wealth decline. Governments also have the power to confiscate or control physical money. During the Great Depression in 1933, President Franklin Roosevelt signed Executive Order 6102, forcing Americans to turn in their gold to the government. Owning large amounts of gold became illegal. Similar events have happened worldwide. Physical assets are not as safe from governments as people believe. Finally, physical money often underperforms in growth compared to digital assets. Yes, gold is stable, but its returns are modest. From 2011 to 2021, gold rose about 10%. In the same period, Bitcoin rose over 8,000%. Real estate grows steadily, but rarely at exponential rates. If your goal is to build wealth quickly in the next decade, physical assets alone may not be enough. Still, despite its weaknesses, physical money remains deeply trusted. Surveys show that over 60% of wealthy individuals allocate a significant portion of their portfolios to physical assets. They do this because physical money provides a safety net. It protects against the worst-case scenarios: economic collapse, cyber attacks, or digital blackouts. In short, physical money is about security, not speed. So, here's the first major lesson. Physical money can keep you safe, but it may not make you rich. It can protect wealth, but it rarely creates massive new fortunes. The question we must now ask is, will digital money do better? Will it not only protect your wealth, but also multiply it? That's where the next part of our journey takes us, because digital money is rewriting the rules of finance, and its potential for wealth creation is unlike anything the world has ever seen. Digital money is no longer a distant concept. It's a reality reshaping how wealth is created and transferred across the globe. Unlike physical assets, digital currencies exist entirely online. Bitcoin, Ethereum, stablecoins, and other cryptocurrencies operate on decentralized networks, allowing instant transactions without the need for traditional banks. Central bank digital currencies, or CBDCs, are being developed by countries like China, the United States, and several European nations, aiming to digitize the very backbone of national economies. These innovations are not just technical, they are financial revolutions that could redefine the next decade of wealth accumulation. One of the most compelling advantages of digital money is scalability. Unlike physical money, which is constrained by storage, transport, and geographic limitations, digital assets can be moved globally within seconds. Imagine sending $1 million across continents in the blink of an eye, without the fees, risks, or delays of banks and couriers. This speed of movement enables new forms of investment, trade, and business models that were impossible with traditional currency. Digital money also opens doors for financial inclusion. Billions of people who previously had no access to banks can now participate in global markets using a smartphone. Another advantage is exponential growth potential. Cryptocurrencies in particular have demonstrated the ability to increase in value at rates that physical assets rarely match. For example, Bitcoin, first introduced in 2009, started with a value of less than 1 cent per coin. Digital money also offers transparency and security through blockchain technology. Every transaction is recorded on a decentralized ledger, making it difficult to manipulate or counterfeit. This level of accountability and traceability is unique to digital assets, creating a system of trust that does not depend on banks, governments, or physical vaults. Smart contracts, self-executing agreements coded into the blockchain, further extend possibilities, automating complex financial transactions without intermediaries. However, digital money comes with risks that cannot be ignored. Volatility is perhaps the most immediate concern. While Bitcoin and other cryptocurrencies offer massive upside potential, they can swing wildly in price over days, hours, or even minutes. One morning a portfolio may be worth a fortune, and by nightfall it could have lost a significant portion of its value. Regulatory uncertainty adds another layer of risk. Governments worldwide are still developing rules for cryptocurrencies and digital currencies, and future regulations could dramatically affect their value. Security is also a concern. Hacks, phishing attacks, and lost private keys have cost investors billions in digital assets. Unlike physical money, if a private key is lost, there is no insurance or way to recover the funds. Despite the risks, the trend is undeniable. Digital money is growing, and early adopters are positioning themselves for potentially life-changing gains. This leads us to the inevitable comparison: physical versus digital money. When comparing the two, 5 critical factors emerge. First, security. Physical money offers stability and tangibility, while digital money offers cryptographic protection and decentralization. Second, growth potential. Physical money is slow but steady. Digital money is volatile but capable of exponential gains. Third, liquidity. Cash is instantly spendable anywhere, real estate less so, while digital money can be globally transferred in seconds. Fourth, regulatory impact. Physical money is heavily regulated but predictable. Digital money faces uncertain regulation that can either propel growth or limit use. Fifth, accessibility. Physical assets often require intermediaries, location constraints, or significant capital. Digital assets can be accessed by anyone with an internet connection. The winner is not immediately obvious, and this is where strategic planning becomes essential. A smart investor will understand that both physical and digital assets have roles to play. Diversification between the two may provide security while capturing potential growth. Ignoring one in favor of the other could limit opportunities or expose wealth to unnecessary risk. Looking forward to the next decade, the potential for digital money to redefine wealth is enormous. Analysts predict that by 2035, digital assets could represent a significant portion of global financial activity. Cryptocurrencies may be integrated into daily commerce, while CBDCs could provide a secure, government-backed digital alternative to cash. Traditional banks will evolve to support these new forms of money, creating hybrid systems where physical and digital money coexist, complementing each other rather than competing. Investors, therefore, must think strategically. How much of your portfolio should remain in physical assets to ensure stability? How much should be allocated to digital assets to capitalize on growth? The balance may vary depending on individual risk tolerance, financial goals, and market conditions. The most effective strategy often involves a combination. Secure enough physical assets to weather crises, while embracing digital assets to leverage unprecedented growth potential. Ultimately, the choice between digital and physical money is a choice about the future you want to create. Those who understand the underlying principles, adapt early and remain disciplined, will have the opportunity to build extraordinary wealth. The next 10 years will not wait for those who hesitate. As we approach the final section of our journey, it's time to focus on actionable strategies. Understanding the dynamics of digital and physical money is essential, but knowing how to leverage them for wealth creation is what separates the successful from the average investor. Let us explore concrete steps that anyone can take to maximize their financial growth over the next 10 years. First, assess your current portfolio. Identify what percentage of your assets is in physical money, cash, gold, real estate, or other tangible investments. This provides a baseline and helps in determining how much risk you can allocate to digital assets. Physical money remains the foundation of wealth security, ensuring that in times of economic uncertainty, your net worth retains value. Next, consider your entry into digital money. Start with small, calculated investments in cryptocurrencies, stablecoins, or digital platforms that have proven track records. Remember, digital markets are highly volatile. It's crucial to diversify within the digital space as well. Investing in multiple digital assets reduces risk and increases your chances of capturing growth from different segments of the market. One effective strategy is portfolio allocation. A balanced approach could involve a combination of 50% physical assets and 50% digital assets, adjusted according to risk tolerance. For conservative investors, the split might favor physical money at 70% and digital at 30%. For more aggressive investors seeking exponential growth, digital assets could represent a higher proportion. The key is disciplined, continuous reassessment based on market trends and personal financial goals. Education is another vital factor. The financial landscape is evolving rapidly, and staying informed gives you a competitive edge. Follow industry reports, read expert analyses, and pay attention to government policies regarding digital currencies. Knowledge enables timely decisions and reduces the likelihood of being caught off guard by sudden market changes. Consider also leveraging technology. Digital money allows for automated investments, smart contracts, and decentralized finance, DeFi opportunities that can generate passive income. By using these tools intelligently, you can increase your wealth creation potential without needing to manually manage every transaction. Automation combined with a diversified portfolio creates a system where your money works for you continuously. Networking and mentorship play a critical role as well. Surround yourself with individuals who understand both physical and digital wealth strategies. Learning from successful investors accelerates your understanding and avoids common pitfalls. Join communities focused on cryptocurrency, fintech innovation, and wealth management. Engaging in discussions exposes you to new ideas and opportunities that you might not encounter alone. Now, let's talk about timing. Wealth creation is not only about the type of money you hold, but also when you make strategic moves. Digital money markets often provide early entry advantages for those who identify trends ahead of the mainstream. Physical money markets, by contrast, reward patience and long-term holding. Recognizing these cycles ensures that you maximize gains from both physical and digital assets. Another important principle is risk management. Never invest money you cannot afford to lose, especially in digital assets. Set stop-loss limits and define exit strategies for each investment. Physical assets tend to be less volatile, but they too require prudent management, such as insuring property or diversifying gold holdings geographically. A thoughtful approach to risk preserves wealth while allowing for growth. Finally, let S address the ultimate question posed in the title: which money will make you richer in 10 years? The truth is nuanced. Physical money provides a solid foundation, a safety net, and long-term stability. Digital money offers unprecedented growth potential, innovation, and access to global markets. The richest individuals in the coming decade will likely be those who master the integration of both. They will hedge with physical assets while strategically investing in digital platforms, capturing the best of both worlds. Your journey over the next decade should therefore focus on informed diversification, disciplined portfolio management, and continuous adaptation. Physical and digital money are not enemies, they are complementary forces. By balancing security with growth potential, patience with calculated risk, and knowledge with action, you position yourself to achieve financial success that few can match. In conclusion, the decision between digital and physical money is one of strategic foresight. Those who embrace the evolving landscape while safeguarding their wealth will thrive. This is your moment to act. Begin today by evaluating your assets, planning your allocation, and educating yourself for the opportunities ahead. Now, take a moment and decide, which side are you on, digital or physical? Comment below and share your strategy. Your financial future depends on the choices you make right now. Take control, invest wisely, and watch your wealth grow over the next 10 years.